Sampath Reddy of Bajaj Allianz Life Insurance now joins us. Sampath, at a record high, also at a record valuation, all data points indicating that we're closer to the top. But do you think we're closer to the top? What does one do in a situation like this?
In terms of most of the valuation parameters, if one were to look at it, whether market cap to GDP or whether price earnings multiple or even price to book value multiples, by and large, we are trading at the higher end of the price, valuation multiples. Overall, what is driving this, this up move in the market is that, there has been a positive surprise in terms of large corporate performance-wise. What has been initially feared versus a significant drop in corporate earnings growth for this financial year. Overall, for the numbers, if you look at it, the nominal GDP growth is declining by likely to decline by just about 4%, and the corporates are also, in fact, earnings as such. There's been a growth of 7-8 percentage point for this financial year, followed by a good growth expected in the next financial year. Overall, the corporate performance has been much better than initially feared, and there's been a substantial amount of the liquidity surge chasing the equity market. And top of it, interest rates have also been quite low. All of these things are pointing towards a higher valuations, but it doesn't mean that we are seeing an immediate correction or anything like that. Given the way the valuations are today, yes, it appears to be very near term, maybe 6 months to 1 year. The market returns may not be very high or significantly better than the kind of a risk premium that one is warranted in the equities. But again, if you look at from a longer term perspective, I think it really doesn't matter. These valuations also one could still make a good money from the market.
Right, I was looking at your sectoral preferences, Sampath, and IT really stands out there with its outperformance. We've seen a near 65% jump in the index itself in the last 12 months, individual stocks moving much higher. What also stands out is the results so far in the IT space have been extremely exceptional. But how much of that is in the price, and is it still worthwhile to make a bet in the IT sector?
Yeah, if you look at the overall valuations as such, maybe the top two companies are trading around 28-30 times multiple, and the rest of the companies are actually trading in the range of somewhere around 20 to 24 kind of a PE multiple. Given the kind of the high cash generation that the companies have, given the kind of high return on capital employed that these companies enjoy, these multiples are not at all expensive. We have seen we are seeing the companies in the FMCG space or even in the paint sector. The valuations are as high as 50-60 times. Vis-a-vis, the way most of the other sectors are trading in terms of PE multiples. Even after the good performance, I think IT still offers a good, attractive, proposition there. And not only that, the business performance or business momentum has, changed substantially in the positive side. If you look at the commentary of most of the companies, the deal win momentum has been very, very strong. So it's actually, backed by the good growth in earnings, good upgrades in earnings. That's why I think even after the strong performance, I think IT sector offers good value for the investments.
You spoke about the BFSI space in the past, and that's another sector that you like as well, Sampath. But with the fear of more regulation coming into the NBFC space, and that space has actually been lacking in terms of its speed, in terms of the rally that we've seen in the market. Do you think there are some headwinds out there? What do you make of the financials right now? The asset quality is going ahead?
I think within the BFSI space, we have been largely preferring the top 5 banks, especially the private sector bank. That's what we have been, most of our investments have been that sector. That space we continue to like. And even in the BFSI space, from what was initially feared in terms of drastic rise in the NPAs post the moratorium gets over, I think that's not happening. Most of the companies' results, or when we talk to them, the rise in NPAs or provision cost is not very, very significant. So that BFS is also the segment we continue to like. And now not only the retail space, I think even the corporate lending side and the corporate book is also beginning to show growth momentum. Overall, that sector continues to offer good value.
A quick one on the auto space before we let you go, Sampath. You do like the automobile space, but lately we've been seeing the auto ancillary space buzzing quite a lot. We saw it in numbers of CEAT. MRF is doing rather well. Just as we speak, Apollo Tyres has hit the highs of trade. Bosch also doing well. Will it be more prudent to play the auto space via auto ancillaries or autos in particular?
Yeah, actually, that's what we have been liking. Within the auto space, we have been preferring to play through the ancillaries, especially the tire companies and some of the companies that you mentioned. There is this little bit of a risk of the disruption in the automobile OEM side. Whether the two-wheelers or even the passenger cars. What if electric vehicles were to come in a significant way, and how soon they're going to come? That's that kind of the uncertainty overhang is there in the auto OEMs, and some of these ancillaries, which whether it's electric vehicles or whether it's IC engines, you would continue to have the same amount of tires. So that particularly, some of these ancillaries are better way of playing the auto exposure. So we've been liking that space. I think unfortunately because of the good raw material price trend, tire companies are doing relatively far better.
Sampath, thanks a lot for stopping by and giving us all your views on the markets as well as individual sectors. Wish to connect with you soon once again as well. Time now to